In this lesson, single candlestick patterns, the learning objective is you should know the different single candlestick patterns. In simple words, a single candlestick pattern is formed by just one candle. The first one we're going to look at is the spinning top. The spinning top does not give any clear direction of the trend, but has a lot of price action associated with it. The body of the candle is very small compared to the upper and lower wicks. The wicks on both sides are generally of similar size. The small main body would imply that the open and close of the candle are very close to each other. Because the open and close are so close to each other, the color of the candle usually does not signal any trend. It is this shape because both the buyers and sellers attempted to push the price in their direction, but were not successful in doing so. The next candlestick pattern we're going to look at is the Marabouzo. I may be butchering the pronunciation here, but it's the name and the word that you should understand, not the pronunciation. The Marabouzo is a single candlestick pattern. The prior trend is not given much importance as only the last candle is important. The bullish Marabouzo has a large real body with a much higher close than open and has no wicks. This pattern is said to be a trend changing one. The intensity of the buying is so high it causes the price to rapidly increase. This candlestick pattern implies that the buying will continue. So if you saw this, you would buy. In a bearish Marabouzo, it has a large real body with a much lower close than open and again has no wicks. A bearish Marabouzo indicates that the selling pressure is so high that the traders are willing to sell at a much lower price, causing the price to rapidly decline. This candlestick pattern indicates a change in momentum and implies that selling will continue. The next candlestick pattern we're going to look at is the Doji. The Doji is a candlestick formation that does not have a real body. It just has wicks on either side, so the opening and closing price of the candles are one and the same. Dojis indicate momentum changing or momentum slowing down. These candlesticks show the indecisiveness amongst the traders about the momentum and the direction of the market. There are four main types of dojis. You have the common one, usually associated with the momentum slowing down, a longer legged one, which is just a common one but just further extended, which is more of a confirmation that the momentum is slowing down or stops or could be changing. The gravestone one is usually bearish because the price went up but failed to form a real body and fell all the way to the close. And like the gravestone, the dragonfly indicates that the price dropped but there was no real body that formed and it closed right next to the open. The dragonfly is bullish and the gravestone is bearish, and the common and long-legged are neutral. The hammer pattern is one of the most reliable trading patterns. It is a bullish reversal pattern that forms during a downtrend. The hammer pattern occurs when the candle opens at a high, but is not able to sustain there, and it falls considerably, but then strong buying occurs, and so price is able to recover and the candle closes in green and near the opening price. The length of the wick here has to be at least twice the size of the body. A bullish hammer often forms at the bottom of the bearish trend and the momentum changes significantly after the hammer formation. One important thing to be kept in mind is that the hammer can be of any color as long as it meets the body to wick ratio. So it could be red or it could be green. But obviously if it's green it's more bullish and if it's red it's less bullish. But as long as the wick is twice the size of the body, it's all good. A few things to know. The execution time of the trade depends on the risk appetite. A risk taker would execute the trade once the pattern has formed, while a risk-averse trader will wait for the confirmation of the trade. Personally, from my own experience, if you take the trade as soon as it forms, you have a greater chance of making money, but it also increases the chance of the trade going against you because it could fall, but 9 times out of 10 it does rise. I would place the stop loss, if you were to buy, below the low of the hammer, so in this area. The hanging man is a bearish reversal pattern. The hanging man in an uptrend warns that prices may start falling. The candle is composed of a small real body, a longer lower shadow, and little or no upper shadow. The hammer and hanging man look exactly alike, but have totally different meanings depending on past price action. The hanging man shows that selling pressure is starting to increase. The longer lower shadow shows that sellers pushed prices lower during the session. Buyers were able to push the price back up some, but only near the open. That's why this is very bearish if it ends up red. Just like hammer patterns, a hanging man pattern can be of any color as long as it meets the body to wick ratio. The stop loss for the short trades executed via hangman tends to be a little bit above the high of the candle. The next pattern we're going to look at is the shooting star pattern. It gives a very strong trend reversal signals. It is a bearish reversal candlestick if the preceding trend is bullish. Its shape indicates that the price opened at its low, rallied but pulled back to the bottom. The shooting star candlestick has a long upper wick. Generally, the size of the wick is twice the size of the candle body. The longer the wick, the stronger the pattern. The inverted hammer and shooting star also look identical. The only difference between them is whether you're in a downtrend or uptrend. An inverted hammer is a bullish reversal candlestick. The inverted hammer occurs when price has been falling. This pattern suggests the possibility of a reversal. The inverted hammer candlestick has a long upper wick. Generally, the size of the wick is twice the size of the candle body. The longer the wick, the stronger the pattern. It's a long upper shadow that shows the buyers try to bid the price higher. However, sellers were able to push the price back down. A normal hammer pattern is more bullish than an inverted hammer pattern. In conclusion, the patterns should give you a deeper understanding of the various single candlestick patterns. You have to be bias free when trading in these type of formations. All the patterns have their individual strengths. You should always trade with a proper stop loss.